So to begin 4.9, we're going to enter the transactions in the ledgers. On the 1st of July, we were given the following account balances. 4 assets: cash at bank, debtors, stock and shop fittings. Assets all have debit balances. They go up on the debit side. So we'll enter those on the 1st of July and write the word balance. We've got 3 liabilities: creditors, loan and GST, and liabilities go up on the credit side, so we'll enter those as credits with the date as the 1st of the 7th and the word balance and the amounts. And then we were given capital, but we weren't told the amount, so we're going to have to calculate that. So to do that, we're going to get our accounting equation and rearrange it to figure out owner's equity equals assets less liabilities. So in this case, total assets were 56,300. The total of the 3 liabilities was 15,000, so that must mean owner's equity is a total of 41,300. So now that we've got that number, we can enter our opening balance of capital on the 1st of July, and the balance is 41,300. Now we can enter our transactions. We bought stock on credit, $1,700 plus GST. We've got an asset going up. We've been charged GST, and that'll reduce a liability, so that'll be a debit. And on the credit side, we've bought this stock on credit, so a liability will increase for the total amount of the stock and the GST. We then paid our insurance, $50 plus GST for 1 month. That makes it an expense. Expenses are debits. Paying GST will reduce our liability, and then we'll have our cash at bank asset will decrease, noticing our debits equal our credits. Then received cash from clients, $880 including GST, and cost of sales $350. So we've got a cash sale. We've got cash at bank going up, which is a debit. We've collected $80 GST, and that will increase our liability. And then we've got sales, which are a revenue increasing, and that's also a credit. We've got to take care of the cost of sale. In this case, it's $350, so our expenses go up, and simultaneously our assets will decrease and go down on the credit side. Pay the monthly loan repayment, so we're going to reduce a liability. Liabilities go down on the debit side, and to do that we had to sacrifice some cash, so that's going to decrease our cash ledger on the credit side. Then we received $600 from a debtor, so we've got assets going up in the form of cash, but another asset going down in the form of debtors. On July the 9th, another cash sale, $750 plus GST, cost of sale $350. So the asset going up will be cash. That'll be a debit for both the sale and the GST amount. Collecting GST, so that'll increase our liabilities, and also making a sale, which is a revenue, and that'll also be a credit. Taking care of the cost of sale, we've got a debit of $350 to the expense and a credit to the asset of $350. Paid $100 for stationery, $10 plus GST. Stationery is an expense, so that goes up on the debit side. We've got a liability, in this case GST, and we've paid GST, so that decreases our liability. And therefore we've got less cash, and cash is decreased on the credit side. We've bought a new computer for $1,650 including GST of $150. So we've got a new asset going up, which is a debit called computer. We've paid GST, that'll reduce our liability, and our cash at bank asset will go down on the credit side for both the amount of the computer and the GST. The owner withdrew $100 for personal use. We call this drawings. So drawings are a negative owner's equity, so that goes up on the debit side. And the drawings have come out of the business in the form of cash, so the business will have less cash, and that'll go down on the credit side. We've received $1,100 from a cash sale. That does include GST of $100. The cost of sale is $500. So we've got an asset going up called cash, collecting GST, which increases the liability. Sales are a revenue, and they go up on the credit side, and then taking care of the cost of sale, which is a debit expense, and then a credit to reduce the asset of stock. We've paid fortnightly wages. Remember, wages don't have GST, so we have an expense going up $650, and also an asset called cash going down $650. Paid creditors for stock purchases from last month. So remember, when we pay back a creditor, it doesn't have GST. The GST is factored in when we buy, but not when we pay. So in this case, we're going to reduce our creditors because we're going to owe them less money. So that'll be a debit, and that'll also decrease our cash at bank asset. We've sold goods for cash, another cash sale, $550 including GST. Got a cost of sale of $300, so debit to cash, credit to GST, and a credit to sales. Cost of sale expense goes up $300, and the sacrifice of stock will decrease the asset on the credit side. We've got another cash sale, $1,200, so we should be getting into a bit of a pattern and realizing how to process these. They're very formulaic and repetitious. So we've got cash at bank going up, GST going up on the credit side, and another credit to sales. Cost of sale expense goes up, and our credit goes in the stock ledger to decrease the amount of stock we have on hand. We've paid our advertising $180 plus GST of $18. Advertising's in expense, that's a debit. Paying GST, so it'll reduce our liability. And we've got less cash, it says we paid it, so cash has gone down on the credit side. Received $660 for a cash sale, including GST of $60, cost of sale $300. So we've got $660 of money, a liability going up of $60, and a sale or a revenue increasing $600. Cost of sale expense was $300, and assets in the form of stock will decrease $300. Sent out a quote for tools, $990 to Luna Homes including GST. Going back to chapter 3 when we looked at the different type of documents, remember a quote is actually not a legal transaction. There's no obligation for the other party to buy, so we don't actually need to enter anything into the firm's books for this transaction. We do have another transaction on the 23rd, which is receiving $530 plus GST for a sale with a cost price of $160. So cash goes up, liabilities in the form of GST and will increase on the credit side, and then we'll have a sale for the difference of $530. Cost of sale expense goes up $160, stock goes down $160. We've invoiced a customer for a credit sale. In this case we've got a debtor going up $550. It's not cash that goes up for this sale, it's going to be debtors instead, but the rest of the transaction will be the same. Even though we've just charged the customer, the liability still increases and sales will also increase. Cost of sale part, that remains the same, whether it's a cash sale or a credit sale. It's a debit to the expense and a credit to the stock asset. We've paid fortnightly wages of $560. Wages are an expense without GST. They will come out of our cash at bank asset, so that'll decrease it on the credit side. We've got cash sales, $1,880 plus GST, a bit of an odd amount, so we just need to be careful when we're doing this in our calculator. So we've actually received $2,068, which is $1,880 plus $188 GST. Once we figure that out, the transaction's straightforward. We can just plonk the amounts into the usual ledgers like so. And the cost of sale was $1,030, so we'll decrease our asset by $1,030.